thank you so much for joining me once again on another episode of Commercial Property Club, our podcast. And I'm so glad to be with you today. Today's episode topic would be centered on build to rent. Actually, the build to rent disruption submarkets of outer rings of submarkets, as well as single family rentals. I'll be right back. Grab your coffee. You want to grab your pad and your pen. You want to take notes, as we're here to add value to you today. I'll be right back. Thank you so much, and you're welcome back once again to Commercial Property Club podcast, and we are embarking on this topic today: the build to rent disruption, submarket outer rings, and also single family renter trends. We'll be examining what it means to compare the aspect of Texas market in the scope of multi-family, as well as comparing it with a single family renter. I'm your host today. My name is Ola Ibiwoye. Now, let's look at the aspect of housing affordability gap. I think that's where we need to start from today. There's a permanent shift taking place across America Sunbelt, as you may have already noted. Texas is ground zero for generations. The progression was simply you rent a traditional 1 or 2 bedroom apartment in your 20s, you get married and you buy a single family and start a home in the suburb, and you plant roots that traditional pathway has enumerated, with 30-year mortgage rates holding elevations and median home pricing in major Texas metros remaining sticky. Sort of the monthly cost of buying a home is roughly 40% to 50% higher than rent as it is right now. As you may already know, the prices of home are up there, really. I could remember almost about 15 or 20 years back when I moved to Texas. They're about 15, 16 years ago. I know what the prices were, and I know what the prices are right now. Families want space, obviously, the private backyard, the number thing, and the quiet neighborhood feel of a single family home. But how would I put it? The current state of things, it's affordability right now. At $2,500 monthly mortgage payment, it's pretty steep up there, and most family can afford that right now. So enter build to rent, horizontal apartment designs, specifically for families today. We are going to analyze how build to rent, that's community in Texas, outer ring suburbs are changing rental dynamics, how traditional Class A apartment can compete, and where investors can find true risk-adjusted returns in this kind of landscaping. It sometimes, when it comes to aspect of real estate, you can, but to see some changes that fits dynamics that come into play in market cycles. Mapping the build to rent boom in Texas outer rings. I'm talking about the suburb area. Well, what are these build to rent projects being built, or where are they? You won't find them in your uptown Dallas or your downtown Austin, your highbrow places like your downtown Dallas. They are thriving in the outer suburb rings, outer suburb areas. suburb areas in outskirts of places like Arlington, just for an example, places like Grand Prairie, submarket locations 25 to 40 miles outside your urban core areas. Dallas-Fort Worth outer ring could be considered places like Salina, Anna, places like Preston, Funny, Waxahachie. And also too, you can look at outer rings like in Austin, Kyle, places like Buda, Manor, Leander, and also too pockets of Georgetown. Those are your outer rings, outer places that you can see built to rent. Places like Houston, you can look at places like Katy, Conroe, and Colony and Waterview, and these are places in which investors are driving build to rent. So now let's see what kind of comparison we can say we would have to your traditional apartment versus built to rent. Your traditional apartment in the spaces of Class A and Class B, it's going to be built in vertical formats, multi-story vertical stack-ups, shared hallways and elevators if the sophisticated ones are included, your high-rise, And mostly they're targeting young professionals, singles, and what have you. A small family. The retention average in that scheme of things in terms of your traditional apartments are between averages of about 45% to 50% annual turnover sometimes. Now your build to rent stacked in horizontal single story townhome layout sometimes, private fencing backyards and attached garages sometimes can be included, mostly targeting families, pet owners, and remote workers in that kind of broad demography. Now, what's the retention in this scope of things, which is a new kind of dynamic in the mostly in the I've seen it in the Texas area mostly. Your retention is in the high 60% plus stay 3-year due in moving extension. So build to rent offers renters private yards, attached garages, and no upstairs neighbors, combined with professional maintenance of a traditional apartment community. So it has some advantages that come in that makes it suitable, or rather makes it on high demands when it comes to small families when you compare that to your traditional apartments. So let's look at how this is underwritten, underwriting build to rent in terms of cap rates, exit caps, and retention. If you're analyzing a build to rent investment, because I've seen OMs on that, recently, in the last few months, we've actually underwritten some in that spectrum. If you're analyzing a build to rent investment or comparing a build to rent deal to a multi-story apartment complex in your Class A, your financial model must account for key structural operational differences in terms of, let's say, your retention advantages, lower turnover cost. The average tenant turn in a traditional apartment cost of about $1,800. That's $1,800 to about $2,500. Between painting or changing, carpet cleaning, lost rents in terms of market cost, your turnover. But your build to rent residents behave like homeowners. They install playgrounds in their fenced yards, plant gardens, and enroll their children in local school district. Of course, apartment residents also do some of all this thing in terms of registering their children in school, but they're not gonna plant gardens around the apartment building, because moving out of a 3-bedroom home is logistically difficult when you compare to families staying in built to rent. Built to rent residents stay length, average stay for them mostly is 3 to 5 years. So you can see that the turnover is quite on the low side, just like I enumerated earlier on in the 60 percentiles. When you compare to 12 to 18 months in standard apartment, your Class A apartment or whatever you, lower turnover means lower annual capital expenditure. As you may see, your maintenance expenses are quite reduced, and steady effective cash flow do ultimately become the reality of your build to rent. So these are great advantages in your build to rent. Then operating margins and HOA style maintenance. Build to rent communities don't have interior hallways, elevators, or complex centrals chiller system that you find in your traditional apartment. Maintenance is largely limited to your roofing, the HVAC units, and landscaping. However, landscaping maintenance across is spread out larger acre, like your 20-acre footprint can be higher than a compact multi-story property in terms of surface area when you compare that to your apartment. So what can we say how in terms of how traditional multifamily, that's another thing I want us to consider. Your traditional multifamily, how does it compete with your build to rent? Because we can see some great advantages in your build to rent, which I enumerated earlier on. How do we compete with build to rent? If you own or operate a traditional Class A or Class B apartment property in a suburb where there are build to rent community opening up or already opened up down the street in a scope of about 3 to 5 miles, how do you compete with such advantages that they bring to the table for renters? You don't need to rebuild your property. You need to implement what I call family-friendly value-add upgrades. That's about it. You need to compete in the spaces or the all spaces of being family friendly. Let's look at some aspect or some things that you can put into play when it comes to value add in your asset. You could implement something like private dog parks, fenced yards, convert your underutilized ground floor green space into private fences, yards for ground floor units, at least for those occupying the the ground floor rather. Having probably 150 square foot fence patio allows you to command they're about $75, maybe $50 to $75 to maybe $120 per month, $125 per month rent premium from pet owners. Now, another thing you can also do is co-working and family lounges. Convert small unused business centers in your lounges into private co-working pods designed for hybrid workers. If you have hybrid workers as renter who need quiet spaces away from home, you can also do that as an added value add that can attract renter. A third thing I could suggest is that you can reserve garage and storage upgrades. Package detachable garages and private storage lockers together to give families the extra storage space that they would otherwise get in a single family home. And those are the things that you can implement to make your competition a little bit up to par with your build to rent as an apartment investor, as somebody that is managing an asset close by build to rent, which are putting you quite competitive, I would say, and they're really pulling their weights out there. To To wrap up today's show, just like I said, Build to Rent addresses a real structural gap caused by single family housing unaffordability in the Texas area. Build to Rent communities enjoy higher tenant retention and lower annual turnover costs, as we've talked about earlier on. Your traditional apartment operators can defend their market shares by just implementing the things that I talked about right now, the target family-friendly outdoor and technology upgrades, which would really attract some family. Build to Rent is not it's not something that you will call a fad. It's a permanent evolution of the scope of housing here in the Sun Belt area in the Texas. So it's come. They're going to be around for a little bit, and if you can add that also to your portfolio as an investor, that would be great. You can seize those advantages. There's nothing wrong in having apartments as well as Build to Rent in your portfolio. You have advantages of both worlds, and pretty much that's what it is. I hope this has been helpful for somebody out there, somebody looking into the spaces of Build to Rent, or rather somebody trying to leverage value add advantage in your asset class, in your portfolio, to make sure you are competing well with the Build to Rent. If you want to connect with me, like I said, you can go to my website, www.commercialpropertyclub.net. You could also send me an email, any topic you want me to cover in terms of the apartment space, commercial property, anything in that space. I will be glad to talk about it. You could send me an email, ola.I@commercialpropertyclub.net. Don't forget to subscribe also with our YouTube channel, Commercial Property Club on YouTube. Leave a review. Share this with somebody out there. There are tons of value had podcast show that we've had in the past. You can share that also too. You can connect with us also too on LinkedIn, Facebook, Instagram. I am Ola Ibiwoye. Thank you for listening to the Commercial Property Club podcast. Stay focused on the demand out there. Keep adding value in the commercial property space. I will see you in another show. Thank you.